Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm your host, Allie Canal, in for Jared Blickery. And with me today is the lovely Sydnee Freed, aka the voice of the people. Kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And to kick things off today, our word and focus of the day is tech. What is going on with the rise of AI, and how should you position your portfolio? And this episode is brought to you by the number 7 in honor of what else? The Mag 7. So to get into all of this today, we're welcoming in Zor Capital Portfolio Manager Joe Fahmy. Welcome to the show, Joe. I mean, there's so much to talk about. Great day, too. We are trading at or near record highs. What's your bird's eye view of what's going on in markets right now?
I feel that we're in a bull market that started late 2022, early 2023, and it's driven by AI. So I'm kind of a market historian geek, and I've just studied history. Throughout history, bull markets are fueled by inventions and innovations that revolutionize our lives. So you go back to the 20s, railroads that got us from New York to LA faster than walking there. So whether it's airlines, whether it's television, internet, just, smartphones, all of them, what they all have in common is increasing productivity. So AI is the new invention, innovation that's leading this bull market because it's obviously increasing productivity. And I think this can go on for another couple of years.
But if we're at or near record highs and it's like all about AI, how do you actually make money in the market? Because I know like it could go up a lot, but I thought you're supposed to buy when the markets are down. So when everything is, golden, how do you like make more money than the next person?
Well, hopefully you just had an opportunity with the tariff scare to get in a little bit lower, and hopefully people have been in for a while. But one thing I've learned from almost 30 years of doing this, I'm 108 years old in case you were wondering.
You look great. What's your skincare regimen?
Not a day over 85.
Thank you. One thing I've learned from doing this for a while is moves in the market go on way longer than we can expect. So in other words, just when you think things can't go higher, they usually do. And just when you have nasty bear market corrections, just when you think they can't go lower, they usually do. So my point is, I'm not afraid to buy a little bit at highs.
Yeah. And I'm curious too, I've been speaking with some analysts about this. Do you think heading into this year, we had maybe a positioning problem where people thought they were too overexposed to tech, so they were moving to defensive plays, they had a lot of cash on the sidelines, and that's part of the reason why we're seeing this move higher in the tech trade?
Yeah, and also the tariffs, look, the headline scared a lot of people. There are a lot of, if you look at the statistics, a lot of institutions are underinvested right now. That's why when you have the Iran scare over the weekend, everyone's like, oh, the market's going to crash. But beneath the surface, institutions have to get in when things are dropping. So there are a lot of institutions right now that are offsides. And I think that's what's keeping this underlying resilient bid to the markets.
And I'm curious, too, if history is any indication, we look back at 2022, right, where the recession that was supposed to happen never came.
Yeah.
So our markets may be thinking, well, if the market's going to continue to be resilient, if the economy can withstand all these changes, maybe we just stay and see what happens, because right now the hard data is pretty solid.
Yeah, the data's great. I always say if you're worried about a recession, just leave your house. I mean, just look around. You can't get into some restaurants.
Yeah.
The airports are busy. I look at Booking, which is the old price line. It's an indicator of travel, not just airfare and hotels, but cruise lines, all this. If that's near a new high, that's a sign to me that things are okay. Now, of course, you're going to have scares along the way and slowdowns along the way, but overall, the economy is still strong.
What do you like in the tech trade right now? Are there specific names, plays you have for people?
I mean, I do like a lot of the AI plays that we recently had a growth scare, but Microsoft and Meta's recent earnings, they said, nope, full steam ahead. We're still spending money and, CapEx expenditure. They're still putting a lot of money into AI. So it's not just AI, but I'm noticing some space names with a lot of great themes. But that's like another 2-3 years down the road. Some retail, not just apparel, but restaurants. I've seen like Texas Roadhouse and Shake Shack and Dutch Brothers. Some of these are near new highs. So there's not just that, but energy as well as a play off of the demand for the energy grid for AI and data centers. So there's a lot of sectors.
And you're alluding to the fact that we've seen this broadening out of this market. And within tech in particular, we always talk about Nvidia. We're trading near records. Do you think this is still an undervalued stock at these levels?
Well, I think it's made a big move. And the big move it made, call it from split adjusted, whatever, 10 to 140. And when stocks and the markets make big moves, they kind of need to digest a little bit, just like after a big Thanksgiving meal, you kind of need to lay sideways on the couch for a little while, sometimes longer. But my point is it made a big move. It gets to be overcrowded. And a year ago, June, it was 140 something. And now it's, just cracking through 140, 150. So it made a big move. It's consolidating. And I still think it still has more upside.
So you recommend buying, because I'm always curious, like for people who are more passive investors, if buying the actual stock is the way to go, or simply investing in an ETF, either a chip ETF or Qs, just something to follow exactly the markets. What do you think?
It depends on your personal preference. I always say do what works for you. Some people don't want single stock risk, so SMH is one of the main semi ETFs. 21% of it's Nvidia, and then you get 10% Broadcom and the Taiwan Semi. So that gives you great exposure to that trade. If you don't want single stock risk, then use an ETF or the Qs for, like as you alluded to. Or if you want single stock risk, you can take along, I always just say manage risk. So even though I might be bullish and optimistic on things, when things, turn against you, you have to always have some sort of a risk management in place.
And if Jared was here, he would tell you. I sit next to him and I ask him every day, is now a good time to buy Nvidia? What are the technicals showing you? Because it's one of those trades where you do have FOMO if you're not in the market. And you talked about the AI productivity boom. Do you think that's being underpriced at the current moment?
I think that there are people way smarter than me, and I know that's a large sample size, but there are people way smarter than me saying that this is bigger than the internet. Like Mark Andreessen, for example, in 2010 or 11, he wrote a piece called Why Software is Eating the World, and he was dead right. And now he wrote a piece a couple of years ago about AI, how it's going to change our lives. And there's so many smart venture capitalists and smart minds that are talking about this is going to be like there's still a long ways down the road. So I think there's still a lot left to this move.
I'm curious as a portfolio manager how you find the next big stock. I know that's what everyone wants to know. And if we all knew it, we'd all be rich. But like, what is the next Nvidia, or what are the indicators that you look for in a stock similar, so in the chip space, that makes you think that's going to be the next breakout star?
It's a great question. I study, as I said, I'm kind of a market nerd, where historically what causes a stock to go up is earnings and sales growth. It's almost like a simple concept, but people forget, like, if you are growing your business, you start a small business and you go from $1 million in sales to 10 million in sales, guess what? Your small business is worth more. So it's the same concept. So if a company historically, they looked at McDonald's before it was McDonald's, and Microsoft and Home Depot, and what caused all of these huge moves was earnings and sales growth. So I'm looking for something now that has very, very strong earnings and sales growth, because as long as the market's cooperating, for the most part, that'll help their stock appreciate.
And we need strong fundamentals in the economy in order to support that earnings growth.
Correct.
So from your clients, what are their biggest concerns? Do they talk to you a lot about the tariff uncertainties, inflation uncertainties? Do they have a lot of excess cash on the sidelines that they're waiting to deploy until later this summer, when potentially we can get a little bit more clarity on the state of the economy?
Yeah, some people, look, I keep the news on because you need to know what's going on in the world, but a lot of it's fear. And it's not that I'm complacent. I just try to encourage them, think, with some of these names longer term, you're going to have corrections along the way. But as I always say, you don't turn on the Weather Channel when it's 75 and sunny outside. You turn it on when a blizzard or tornado or hurricane's coming. So my point is, the news is designed for the most part to scare us for ratings. So I take it all with a grain of salt.
How do you then know when a news headline hits, an event happens, and you need to adjust your portfolio versus ignore?
Well, we saw that with the Middle East, right? We had this reaction, and then stocks closed in the green on Monday.
Yeah. That's the line. It's not the news. It's the market's reaction to the news. So when things really started to break down in 2020, where we weren't sure if COVID was going to be a big deal or if it's going to spread, wherever, when it really starts to break down, that's the market's reaction to the news. When it breaks certain technicals where the institutions normally support and they're like, we're getting out of it, that's when you have to heed the warning there. But in the case of the recent Middle East crisis so far, the news has been miserable, but the market's resilient. So that's an example of the market's holding support.
So how do you train your mind then to be that investor that doesn't get scared, that stays in it when it's tough? Because the mental toughness element of it is scary.
Yeah.
That's the tips.
Yes.
If you're a trader, you have, I don't know, you have a few choices. You either turn off the news, except for you guys, because you can keep you guys on.
But that's actually a thing right now that people are talking about, that you're better off not looking at the news and just staying invested.
Yeah. Or to use your expression, mental toughness. That's another option. It's say, okay, I can keep social media on, I can keep the news on and take it all with a grain of salt. Or your other option is blame your parents for raising a wimp. Those are your other options.
I always try and reframe it too. And we've seen a lot of aggressive dip buying, especially on the part of retail traders, that when the market goes down, to view it as more of an opportunity rather than a scary moment where you're going to be losing a lot of money and not focus on the red in your portfolio.
Yeah, what's that line with the market's the only place where when things go on sale, people run. Otherwise, people usually go for sales and stuff. It just all depends on your time frame. With the indexes and the ETFs, over every 10, 20, 30-year period, they go up. They're designed to go up because they take out the weaker stocks and put in the stronger ones. But with individual stocks, you do have to be a little bit more careful because they don't always come back. So it just depends on your time frame and your strategy.
This might be an odd thing to ask, but are there any pullbacks you are anticipating in the next few months? Any events that investors should watch out for that could cause a pullback?
I wouldn't be surprised this summer to see a pullback. August and September, again, being a historian, August and September are traditionally two of the weaker months of the year. So a lot of people go away, Hamptons, all that stuff. So you tend to see a lot of institutions might sell and just take some time off in the summer.
But should people stay?
I mean, we have Jackson Hole in August. We maybe have a Fed cut coming in September.
Yeah.
How much of a catalyst could this
Again,
be?
it's the questions you're asking are awesome.
I know, it's just a ball.
It's just impossible to answer because if you tell someone who's dollar cost averaging in ETFs over 30 years, it doesn't matter. But if someone's actively managing a portfolio and things have been strong over the past month or two, then maybe going into July, you could take a little bit off the table. But again, it's just it's just a case-by-case basis.
And we saw the sell in May go away. That didn't
work?
That didn't work out too well. But Joe, stick it right there. We will need to take a short break. But we'll be right back with Joe and more Stocks in Translation next. Welcome back to Stocks in Translation. We're here with Zurich Capital Portfolio Manager Joe Fahmy, and we were just talking about how we need to evaluate different risks within this market right now, whether it be from the economy, whether it be from the Fed. And you were saying that it depends on your time horizon.
Yeah.
So how does that differ when you're a long-term investor versus maybe when you're nearing retirement?
Well, they say as you get closer to retirement, reduce a little bit more of your equity exposure and maybe more into fixed income. And it's not, depends on your risk, but the good thing now is for the longest time, it was, ZIRP, zero interest rate policy. So if you had, and you retired and you had money in the bank from the financial crisis up until 2021, you might get like 7 cents interest on your money for the month. But now that you can get 4.5% on the 10-year and on certain CDs in the bank. So as you get closer to retirement, you can have a little bit more in cash because at least you're getting some interest off of that.
Do you have a recommended asset allocation? I know that's broad and it differs for people with longer runways, but I don't know, let's call it an earlier investor, 20s, 30s, and then maybe a middle age, 40s, 50s.
I think if you're younger, all stocks. They say it's supposed to be 100. Take your age take 100 minus your age, and that's the percentage to be in stocks as a guideline. So if you're 30, you should be 70% in stocks. Okay. But I think if you're 30, you should be 100% in equities.
So no bonds.
That's young, so.
No, I ask because with the recent drawdown, I was thinking about my own portfolio and like do I need any hedges for volatility, something like gold?
Yeah.
I really genuinely was thinking to myself, do you need this?
And I'm the opposite because I feel like I have no hedges and I just try and keep
I don't think I have any right now. My
in terms
point
of
is,
defensive plays,
Yes.
gold, yes.
so my point is, do I need them?
If you're in the S&P with 11 sectors,
That's
when the
true.
market drops, you're going to have one of those sectors as utilities.
Yes, that is true.
So there is a defensive component to that because 500 stocks is a lot of diversification.
Right.
And a lot of them, most of their revenues do come internationally. So you do have international exposure. You do have, some, technically fixed income through the dividends and so forth. So again, it's a little bit different where I might be positioned a little bit more as a growth manager towards being a little bit more aggressive. But if you're younger, I say, hey, stick with the SPY or the Qs longer term.
and you're naturally hedging yourself due to what you were just saying. You
Yeah.
have so much exposure to different types of companies.
Or I do reduce and raise a little bit of cash at times when I feel like, okay, it's been a good run. Nothing wrong with cashing a little bit. Because even though I think this market's going to go on for 2 or 3 years, it's not going to go straight up. Even if you compare it to 95 to 99, which was an incredible boom with the internet. 97, there was a Japanese currency crisis, and 98 was a Russian debt crisis with long-term capital. And so there were scares along the way during that amazing run. So the analogy is there's going to be, just recently, the tariff scare was almost a 20% correction. So there's going to be hiccups along the way.
You basically answered this, but I just want to hear it again. You consider investing in all of the different sectors a level of diversification, right?
Yeah.
Because when I think about that, I think stocks, bonds, gold.
Gold, international,
Yes.
fixed income, and all. Everyone has, a traditional financial advisor is going to asset allocate that for you. I'm not traditional, I guess. I don't like to blend in with everybody. So
we like that though.
We like it.
We don't want to be
So-
boring over here.
No, I don't want to be boring. I mean, I think with they say 20 stocks is perfect diversification. So when you have 500 multinational companies, that's almost over diversification. But it gives you broad exposure to a lot of sectors.
What about FOMO chasing, momentum chasing? We hear these buzzwords
Yeah.
all the time, and it feels like with applications like Robinhood, retail traders, just
Yeah.
getting into the game a little bit more. What's your perspective there?
FOMO's cured with discipline. That's my perspective. So it's one word, acceptance. I accept I can't own everything. So look, there's going to be some hot quantum computing names that go up 200-300%. There's going to be some hot nuclear names. I've seen them already in the markets, but I see some of them, but you can't chase everything. You just have to say, okay, I got to accept I just can't own everything. And that's part of the discipline. And trust me, I learned the hard way because I used to do that. But then all of a sudden you own 50 names and then the market corrects and you're like, what do I even have in my portfolio? I don't even know what these companies are. I just chased them because someone on social media was talking about them. So you need to have some, the chocolate cake's going to be there. You got to have some discipline. You have to try to control yourself once in a while.
Something you sent in your notes, you said there's a lot of bullish activity in the major tech names.
Yeah.
For options.
Yeah.
What do you think of options for a passive investor? Should that be a non-existent thing? How do you even start?
Sid takes out her notebook.
Yeah, I'm dying to know if I need options.
Well, it depends. I follow unusual options activity because a lot of the big institutions use it to build positions in stocks and so forth. Some people, a common strategy is covered calls where you own the stock and you write, if you think, like I gave the example with Nvidia, it makes a big run and it's been consolidating, or even Tesla made a big run and consolidating. Some people write covered calls against that. That's just something I would either look into, and I don't want to say it's dangerous, but it involves risk like everything. So you have to educate yourself on it.
But you use it as an indicator of what some of the bigger institutions are doing.
I follow what they're doing because whether it's someone like a Bill Ackman or even Carl Icahn when he got into his Netflix position, they do it all through options, big blocks of options, in the money options. Some of the activist investors do that as well. So because liquidity is an issue. So if you want to buy 200,000 or 1,000,000 shares, you could just buy 2,000 contracts, and then they automatically execute that for you. So I like to watch what they're trafficking in because it gives clues.
That's smart. That's smart. And I want to switch gears to a segment we like to call Lost in Translation. And this is what the market may be misunderstanding. And I want you to explain why the Netscape web browser release is similar or different from the ChatGPT release.
So that's the comparison I'm using is that this bull market that let's say it's going to be 2023 to hopefully 2027 or longer is similar to the internet, 95 to 99. And right around 94, 90, 95, it was actually a chart from Bespoke Investments, which I found very fascinating because the crack invention of the time was Netscape browser at the time. And ChatGPT came out in late 2022. So it's amazing how the NASDAQ and releases of both of those products has literally tracked almost identical. So I almost compare it to the crazy invention of the time then and now that a lot of people are scaling up and using. They're tracking each other very similarly.
Have you been surprised at the mass adoption of ChatGPT at this point?
Fastest application to 100 million users. 2 months. Faster than... the list is endless of, whether it's Facebook, Instagram, all 2 months for even TikTok, faster than all of that stuff. So they're estimating maybe even 1 billion active users. So
wow, it's crazy. Do you trust it though?
Yeah. Is there an element of it that's a little scary?
Well, you just have to say thank you at the end, just so it doesn't come after you and
have to be nice.
destroy your computer or end your life somehow. Just be polite with AI.
I love that. I want to end on a personal note. I want to know how one becomes a portfolio manager in the first place and starts studying markets.
Mm-hmm.
I think everyone has a passion that they're interested in. Some people I know are amazing chefs where they just start cooking and then it just becomes a passion. It's just something, I love the markets, and as I've been putting out content and been grateful you guys have been able to let me contribute and other stuff through my blogs. Like, I think it's just as you put out stuff, if people reach out and they say, hey, we're interested, we like what you're saying, we're interested in you managing money. And that's when I became an advisor. And so I think it's a different way of doing things, but if people like what you have to say and your content, then they end up reaching out, and then it decided to make a business out of it. So
yeah, and you have a podcast too.
I do.
Where can people find you? What do you talk about?
It's called Joe's Happy Hour.
Joe's Happy Hour.
Yeah.
I love it.
Do we get to drink martinis?
Exactly. You can,
and it's in Vegas too.
It's
That's
in
where
Vegas.
you film it.
Yeah. When I'm out there, I have a lot of clients out there. So when I'm there, I do film, and it's music people, but I don't want to make it all business. As I was telling you earlier, I talk markets all day, which I don't mind, but I've been lucky to know some people in music, sports, finance and so forth. So it's fascinating to me and I'm enjoying it.
Is there anything you find challenging about it?
You know, it is. Time flies when you're having fun and all that. So if it's a conversation I'm enjoying, the time flies. If it's, oh no, like my fear would be, I just don't know what to ask next. Yeah. And then I look up and I'm like, how do I get through the next 45 minutes of this? So,
well, speaking of time flying, unfortunately, we are also out of time here. We're winding things down at Stocks in Translation, but make sure to check out our other episodes on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, so be sure to leave a comment, and subscribe wherever you get your podcasts.